When you transition to a fixed income, your largest asset is often the one you are sitting inside. Paying for daily living expenses, medical bills, or property taxes while your savings slowly drain creates a very specific kind of anxiety. A home equity conversion mortgage, or HECM, is a tool built to solve that exact problem. It allows homeowners 62 and older to convert a portion of their home equity into cash without taking on a monthly mortgage payment. But the decision to use one is heavily clouded. Television commercials promise easy, tax-free cash, pushing viewers toward online calculators that spit out numbers lacking essential context. This matrix shows the disconnect. The marketing suggests you can access the bulk of your home's value. The reality is that strict FHA limits, your age, and current interest rates immediately slice that number down. Calculators cut through the sales pitch to show your net proceeds. This is the actual liquid cash you can use. We are going to reverse engineer the HECM calculation process. We will look at the specific inputs that determine your borrowing power and locate the mandatory fees that drain your final payout. Grounding your expectations in the math protects your estate and your peace of mind before you ever enter a lender's sales funnel. Every calculation starts with the principal limit factor. This is a strict percentage table published by the FHA that dictates exactly how much of your home's value you are allowed to borrow. This chart shows how the math treats your age. The system uses the age of the youngest borrower on the title. A 62-year-old might only access 50% of their equity, while a 75-year-old sees a much higher limit. The older you are, the shorter the projected loan term, so the FHA allows you to borrow more upfront. But watch what happens when expected interest rates rise. Higher rates force lenders to account for faster debt accumulation over your lifetime. As rates go up, your principal limit drops to offset that future cost. And this entire calculation is capped by the FHA claim limit. If your home is worth $3 million, the math still stops at the federal maximum, ignoring any value above that line. The math works this way because of actuarial reality. Reverse mortgages do not require monthly payments. Instead, the interest compounds every single month and is added to your loan balance for the rest of your life. If you are 62, applying during a period of 7% interest rates, you will receive a small fraction of the proceeds offered to a 75-year-old applying when rates are at 4%. Taking out a reverse mortgage the moment you turn 62, or when market rates are peaking, permanently locks away a massive portion of your borrowing power. Let's track a $500,000 home through this waterfall chart to see exactly how your final payout is determined. We start with the gross property value. First, we apply the principal limit based on your age and the current rates. You immediately lose access to a large chunk of that equity. Next comes the existing mortgage trap. By law, any current mortgage debt must be paid off using your new reverse mortgage funds. This provides an immediate cash flow benefit. You completely eliminate your monthly mortgage payment. However, if you still owe $200,000 on your home, that entire amount is subtracted from your available limit. It clears the debt, but it leaves you with almost zero liquid cash in hand. Now we hit the upfront costs. Lender origination fees are capped by the FHA, but they still deduct up to $6,000 directly from your available limit. Then the FHA takes a mandatory 2% upfront mortgage insurance premium. On a $500,000 home, that is another $10,000 gone before you see a dime. This final column is your true net proceeds. A $500,000 home might only yield $80,000 in actual spending power after the formula and fees take their cut. Getting rid of a monthly payment is a lifeline for many retirees, but paying tens of thousands in upfront fees makes this a catastrophic financial choice if you plan to move, sell, or downsize within 5 years. Once you calculate those net proceeds, you have to decide how you actually want to receive the money. This line graph shows the lump sum option. You get all your available cash on day one at a fixed interest rate. But as you can see, the line stays completely flat. You have permanently locked yourself out of any future equity growth. The alternative is the line of credit. This is completely different from a standard bank home equity line. With a reverse mortgage line of credit, interest is only charged on the money you actually pull out. The funds sitting in the account are completely protected. But here is the major mechanical advantage. The unused portion of your credit line automatically increases in borrowing capacity every year, tracking with current interest rates. This growth happens regardless of what the housing market does. A lump sum makes sense if you need to pay off a massive medical debt or completely remodel a home today. A growing line of credit is built for the long game. By sacrificing the immediate cash payout, you create an expanding financial safety net. It serves as a highly effective hedge against future healthcare costs or the need to sell stocks during a market downturn. The trade-off is clear. A reverse mortgage is the most expensive way to borrow money, but it's the only way to borrow without monthly repayments. This decision tree maps who should use this product. If moving, stop. Upfront fees destroy equity. If staying, you must pay taxes and maintenance or face foreclosure. The optimal candidate is 70+, with high equity, low debt, and plans to stay permanently. That brings us to the final variable, your heirs. Compounding interest steadily eats away at the home's remaining value. Over 20 years, your heirs will likely inherit a property with zero remaining equity. Because these loans are strictly non-recourse, FHA insurance covers the difference if the balance exceeds the value. Your kids will never owe a shortfall. Before you enter data into an online calculator, gather your exact current mortgage balance and research recent comparable home sales. Skip the county tax assessment. It will skew your results. A reverse mortgage is a tool of precision. Run exact numbers, understand the fees, and let the math dictate if this strategy secures your retirement.